Most people do not lose money in gold because they misunderstand gold. They lose money because they think the price on the screen is the whole market. That is the real trap. A war breaks out. Oil surges, the world feels more dangerous. Every textbook says gold should rise, then gold gets hit hard. And if you do not understand how the modern gold market is actually built, that move feels impossible. It feels like proof that gold failed, that the thesis broke, that the safe haven was never safe at all. That is exactly where ordinary investors get washed out. Not because the metal stopped mattering, because the structure above the metal behaves very differently from the story people were taught. That is the divide. So let me give you the one mother line that everything in this story serves. Gold does not crash in crises because its long-term role disappears. It crashes when paper pricing, margin pressure, dollar demand, and forced liquidation overpower the physical story in the short run. That is the line, not magic, not one villain, not one conspiracy theory you have to marry forever. Structure, because once you understand that, the whole event becomes more legible. Margin hikes stop looking technical. Central bank selling stops looking random. A stronger dollar stops looking unrelated. COMEX stops looking like a clean reflection of physical supply and demand. You begin seeing that what retail investors call the gold price is often a paper battlefield sitting on top of a physical market, moving to a different logic entirely. That is the deeper truth. Now let me show you the mechanisms. The first mechanism is paper price control. Most people think the gold price comes from people buying and selling bars. It usually does not. The quoted gold price most investors see is overwhelmingly shaped by futures markets, especially COMEX. That means the price is formed in a world where contracts can represent large quantities of gold without most of those contracts ever ending in physical delivery. The market is dominated by claims, not bars. That is paper price control. This matters because a paper market can move violently without the physical market agreeing in spirit. If enough leveraged positions are forced to sell, if enough contracts are dumped, if enough short-term players get flushed, the quoted price can collapse even while long. Term physical buyers are getting more interested, not less. The screen says panic. The vault story may be saying something else. That is what ordinary investors are rarely taught. They assume one price means one reality. In gold, there are at least two realities: the paper price and the physical positioning underneath it. Confusing those two is where the pain begins. Now let us move to the second mechanism. I call it margin cascade. This is market structure becomes brutal. When the exchange raises margin requirements, it is not issuing an abstract policy statement. It is changing the amount of collateral traders must post to hold positions. If gold has already risen strongly and many traders are long, raising margin requirements can become a pressure weapon. Small or leveraged participants suddenly need more cash just to stay in the trade. If they cannot produce it, they must sell. That is margin cascade. The selling lowers the price. The lower price weakens more positions. More positions get margin called. More selling follows. And what looked like a normal pullback turns into liquidation logic. This is why crashes in gold can feel engineered, even when you do not need to claim a cartoon plot to explain them. The structure itself creates a powerful downward reflex once collateral demands rise into a highly leveraged positioning environment. Big players with deep balance sheets can ride the storm. Weaker hands get ejected, the price breaks. Confidence breaks with it. This is one of the oldest games on Wall Street. Change the collateral pressure. Let leverage do the rest. That is margin cascade. Now let us move to the third mechanism. I call it dollar squeeze. A lot of people still think of gold and the dollar as separate stories. In a real crisis, they often become the same story from opposite sides. That is dollar squeeze. When war expands, oil spikes, import costs rise, currencies come under pressure, and institutions around the world suddenly need more dollars to pay for energy, defend exchange rates, or satisfy funding demands, Gold becomes something that can be sold to raise those dollars. Not because the sellers hate gold, because gold is liquid and dollars are immediately required. That is the squeeze. The dollar strengthens. Gold becomes more expensive for non-dollar buyers. International demand hesitates. More entities sell gold to obtain cash. The price weakens further. And retail investors watching the move from the outside think the metal itself has somehow betrayed them. It did not. The funding environment changed. This is why a stronger dollar can be bearish for gold in the short run, even when the deeper geopolitical backdrop is exactly the sort of thing long-term gold bulls were warning about. Crisis does not always mean instant gold upside. Sometimes crisis means the system grabs the most liquid collateral it can find, and for a while that collateral is gold, that is dollar squeeze. Now let us move to the fourth mechanism. I call it sovereign liquidation. This is where the official sector layer enters. When countries face surging energy costs, weakening currencies, wartime uncertainty, or the need to stabilize domestic financial conditions, they do not always respond with elegant long-term strategy. Sometimes they sell what they can sell. Gold qualifies. That is sovereign liquidation. A central bank with meaningful gold reserves may dump metal into the market because the domestic currency needs support, import bills need to be paid, or a broader fiscal or geopolitical stress event is forcing immediate action. To the public, it can look like the sovereign suddenly lost faith in gold. Often the reality is simpler and colder. They need dollars now. Gold is what can be turned into dollars. Now this mechanism matters because sovereign sales can be large enough to hit global pricing hard. The market does not wait for some neat explanatory memo. It feels the flow. A few big official sellers can do enormous damage to paper sentiment, especially when the broader market is already vulnerable to margin pressure and dollar strength. That is how a crisis asset gets sold in the middle of a crisis. Not because the long story died, because the short funding story became dominant. That is sovereign liquidation. Now let us move to the fifth mechanism. I call it vault distrust. This is where the story stops being about immediate price and starts being about long-term confidence. When major states quietly remove, relocate, replace, or repatriate gold from foreign custody arrangements, they are sending a message whether they say so openly or not. The official explanation may sound technical, about standards, logistics, efficiency, or compliance. The real meaning is usually more important than the wording. That is vault distrust. Gold is not only a commodity, it is confidence stored in metal. If a country no longer wants as much of its metal sitting in another country's vault, or if it prefers to sell there and rebuy closer to home, that may signal anxiety about control, delivery, sovereignty, or future access. You do not need to prove every conspiracy theory in order to recognize the basic pattern. Trust around custody matters. If trust weakens, gold's political meaning strengthens, even if the short-term paper price remains messy. This is why repatriation stories matter so much more than most mainstream coverage suggests. The public hears logistics. The serious observer hears strategic caution, and when multiple countries begin acting that way around the same time, it becomes very hard to dismiss as coincidence. That is vault distrust. Now let us move to the sixth mechanism. I call it east-west divergence. One of the strangest features of modern gold is that Western price action and Eastern accumulation can be moving in opposite directions at the same time. That is not a contradiction. It is a clue. That is east-west divergence. In the West, leveraged funds, futures traders, and short-term institutions may be puking out positions under margin pressure or chasing the stronger dollar. In parts of Asia, central banks, insurers, private savers, and long-horizon buyers may be taking the exact same price drop as an invitation. The West sells paper, the East absorbs metal, the chart looks weak, the long-term physical bid quietly gets stronger. This matters because it teaches you what kind of market you are in. If the decline were truly about gold losing its structural role, You would expect weaker physical appetite as well. But if physical uptake remains resilient while paper positioning collapses, the move may be less about thesis failure and more about temporary paper dominance. That is the difference. Smart money tries to study not just who is talking, who is taking delivery, who is allocating reserves, who is treating price weakness as exit, and who is treating it as transfer. That is east-west divergence. Now let us move to the seventh mechanism. I call it reset accumulation. This is the part most ordinary investors never fully absorb until it is too late. Big players do not mind a crash if it helps them own more. That is reset accumulation. If margin hikes shake out weaker longs, if sovereign selling knocks the price lower, if the dollar squeeze scares retail holders, and if the physical story remains intact underneath, then the crash becomes a clearing event. Weak hands get removed, the narrative gets damaged, the public loses confidence, then stronger institutions, larger buyers, and longer horizon accumulators step back in at better prices. This is not unique to gold. It is one of the oldest patterns in markets, but it is especially vicious in gold because so many holders believe they are buying safety. Then discover the path to that safety can be far more violent than they expected. They wanted the hedge. They did not prepare for the structure. So they sell into the very reset. The larger players were happy to endure. That is why structure matters more than slogans. Gold may still serve a serious long-term role. You may still get destroyed if your position size, leverage, timeline, or emotional setup were built for a straight line that this market has never promised. That is reset accumulation. Now, I want to force the identity shift because without it, this still sounds like a gold rant instead of a usable market philosophy. Stop thinking like a price watcher. Start thinking like a structure reader. A price watcher asks, why did gold fall during war? A structure reader asks what happened in paper markets, margins, dollar demand, sovereign flows, and physical accumulation. A price watcher sees one contradiction. A structure reader sees layered markets operating on different time horizons. A price watcher panics when the chart violates the story. A structure reader asks whether the chart is reflecting long-term thesis failure or short-term liquidation mechanics. That is the stronger identity, because once you think that way, the whole event becomes less emotional and more instructive. Margin hikes, COMEX positioning, reserve behavior, repatriation, dollar strength, Chinese demand, insurer allocation, central bank buying. These are not side details. They are the actual machinery. And now, let me give you the operating system plainly. Never confuse the paper gold price with the full physical gold story. They can diverge sharply. Second, respect margin structure. In leveraged markets, collateral changes can do more damage than geopolitical logic in the short run. Third, watch the dollar. Gold often gets hit when global systems suddenly need dollars more urgently than they need narrative consistency. Pay attention to sovereign selling, but read it correctly. Immediate funding stress can force sales without disproving the long-term case. Fifth, treat vault repatriation and custody shifts as strategic signals, not boring logistics. Sixth, look for east-west divergence. Paper weakness with strong physical accumulation is a very different market from broad abandonment. Seventh, size positions and time horizons so you can survive resets instead of becoming part of them. That is the heart of it. Gold did not have to fail for the price to crash. The structure only had to favor liquidation over thesis for long enough to flush the weak hands. That is how this market works. Now let me end where this really matters. You can keep believing the chart is the whole truth. You can keep assuming safe haven assets move cleanly according to textbook logic. You can keep getting emotionally whipsawed every time the paper price violates the story you were sold about what gold is supposed to do, or you can do the harder thing. You can study the structure. You can track the dollar. You can respect margins. You can watch who is selling and who is accumulating. You can separate paper panic from physical positioning, and you can build a gold strategy that is designed to survive the reset instead of getting washed out by it. That is the threshold, because the people who benefit most from a gold crash are rarely the ones who were most loudly bullish. They are the ones who understood the machinery well enough not to get forced out while the transfer was happening. That is the mirror. Look into it carefully. If your entire gold thesis still depends on the idea that the screen price must instantly reflect the long-term truth, then whatever else is true, you are still standing in the wrong part of the market. The moment you understand the layers is the moment you stop being easy to shake out.